So I feel like the market's really caught up in a crossfire between the negative news in the media and the Fed speech, as well as, on the flip side, the fear of missing out, and maybe this is the buying opportunity of this decade. Stick with me as we explore the crossfire of the market. My name is Brian Cannon, and welcome to Markets in 5. I realize I might be sounding like a broken record here, but I think during this episode you're going to see why. It's just something that's so important that we're watching. But essentially, I've been talking about the fact that when the market breaks out, it's gonna test this resistance line and test it as support, and it's either going to hold up as support or it's not. And if it's not, it's going to be a fake breakout, and it's going to resolve itself down. Or if it does hold, then that's good. And support is always good, and as long as we head up. So right now we're still in the clear from the standpoint of the support zone. So we did break out, we've come down, we've tested it. But it's to me, we've got a lot to prove, right? So it's going to chop around here for a while. So until we can kind of get higher lows and higher highs over here, there's not going to really be a solid answer for us, and that could take a while to resolve. Now conversely, if it comes down, shatters around a bit, kind of bops up and down, and eventually works its way down below this line, that would not be good, and we would take measures to protect at that point. All right, so I've taken the liberty to visually draw a couple of hypothetical scenarios that could happen, and really what we're looking for when we're monitoring the situation that we're in right now. So again, if we take the S&P and blow it out a couple of years, you can see the march up in 21, you can see the precipitous drop in 22, and then you can see right here in 2023 this kind of march up in January, the fall down in February, and now we're chattering around here in March. So the good news is, again, we've broken the trend line. We're on the upside of that, which is great. However, what we need to see is we really want to see this market in the green on all three of these scenarios, right? So we want to see the market, it may chatter around here for a while, but essentially we want to see it kind of take out this most recent high and eventually start to build off of this breakout. And if the market does that, I think you're going to see that the RSI is going to hang out here above the 50 line. And so, again, when the market trends, the RSI really just tends to hang in the upper quadrant of this scale. And so we really want to see that to help kind of confirm a move to the upside. And in addition to that, you want to see the MACD as well. You want to see that indicator really kind of heading up north of zero and staying up there as well. Now, conversely, we're watching if the market, does kind of chatter around here and ultimately break down, we're going to see that the RSI is going to be hanging down here below the 50 mark, and we're going to see MACD really kind of break back down below the zero mark. And so those are the indicators that we're really paying attention to help guide us and help us determine, is this market breaking out with legs, or is it still chopping around for a bit, or is it breaking down and really not looking good, or is it still just chopping around a little bit? So again, these indicators, along with some others, really help us to kind of determine the state of the market. All right, so then this final chart is the yield curve inversion. I know I've showed this a couple of times as well, but I just think it's so important this time to really pay close attention to really the warning that it's sending the market right now. So if we look back to the yield curve inversion of 2000, which preceded the tech bubble, which basically took about 50% of the market over a 2.5-year stretch. That yield curve inversion preceded the recession and the drop in the market. And essentially it wasn't until the Fed started to lower rates that the yield curve normalized, and but again, that was all in efforts to basically save the market from continuing to just tip into off the edge of the cliff. And if we look at the yield curve inversion of 2006 to 2007, again, that preceded a major U.S. recession and a stock market crash that lost essentially 57%. So and again, once the yield curve started to correct was when the Fed started to lower rates to really try to save the market from, again, tipping off the cliff. So here we are now. This yield curve inversion we have is so terribly inverted. So far worse than the one in 2000 and way worse than the one in 2006 or 7. So I think it would be a little bit crazy to think that we're not going to have a recession. And I think this chart could be sending a warning sign that it might be worse than what a lot of people think. Again, time will tell. And so I'm not going to try to make any predictions off of this chart specifically, but I think we do have to use the information within this chart to at least give us a little bit of caution, and it certainly at least help us to be prepared, so it doesn't just become the next shock stock market that no one saw coming. I think this is a very, very highly predicted recession. So we'll see, if that works out the way that it might. So as you can see, there's a lot of chatter and chop we've got to kind of get through, but I think we're going to get our answer pretty soon. We're either going to resolve ourselves to the upside or to the downside, and either way, we're going to be prepared to handle that. But if you have any questions or need anything, certainly give me a shout, and I'll see you on the next Markets in 5.